Yeah, good to see you, Scott. It's interesting because at, I don't know, the start of the day today, call it 8:31 a.m. to be exact, when the numbers came out, the payroll numbers came out north of 300,000, I was absolutely certain that the Fed was going to use that for cover to go 50 basis points at the next meeting. And then the news around Silicon Valley Bank, and all of a sudden, I don't know which direction they will go. I think this is probably the most precarious position the Fed has been in since we started this particular cycle. And that's, the last year and a half that we've been talking about them having to do something aggressive to fight inflation. I think this is the toughest call the Fed has had to make throughout that entire cycle, because on one hand, we've seen just how hard those initial rate increases going so fast and so high have impacted the financial sector. But there's also an argument to be made that there's still some work to do on inflation, long-term inflation, and that's the Fed's mandate. So it's a really tough call, heads you lose and tails I win kind of scenario. And I honestly don't know why anybody would be putting new money into the market today unless there's one or two particular stocks that you've been watching for some time and you absolutely can't think of a better entry point than the one you see before you today.
So this makes you more defensive just by nature of the unknown that still lies ahead.
That's right. I have gotten more defensive in the very short term, even before today, saying to folks that you're better off hiding out in the 2-year, like you just pointed out, which is going to get you somewhere between 4.5% and 5%. Why bother tipping into the pool of risk when you know with certainty where you can get some yield in the short term and see what happens? And that was heading into the meeting before I knew the Silicon Valley news was going to break, and there would be questions circling around the financial sector. So I don't see why investors would want to be chasing this particular downtrend, especially in the financials, because we just don't know how much contagion there really is. And not even necessarily from a technical perspective, but more sentiment driven than anything else.
Let me just ask you this before I let you go. Let's just for argument's sake and the sake of this conversation say there's no contagion, okay? This is idiosyncratic. It's not going to have a run-on or systemic risk of any kind, but it will force the Fed's hand, and it will make the Fed stop sooner than just a few days ago it sounded like they were ready to do. Why isn't that bullish?
But doesn't the market still have to fall at that point, since the consensus that I was fighting against, I think back in January, I was on with you and I was saying that I think anybody who's saying that they're pricing in a cut toward the back of the year is making a mistake, and there's absolutely no way the Fed decides to start cutting. I did think we would get a pause, but I thought a cut was absolutely ridiculous. And now we're making the case that the cut is already baked in, which means that it's got to come back out, right? If we're saying that we get a pause and nothing else, or we continue to get raises, that lessens the likelihood that that cut happens. And if the market has been, in positive territory, January at least, because of the expectation for that cut, then that has to come back out somewhere. And so I still think it's a bearish signal in the near term until we find out exactly what the Fed's plan actually is in the next meeting in a week or so.